What the heck is going on with interest rates these days? That's the question I'm getting asked a lot by both buyers and sellers, and we're going to see if we can make sense of what's actually happening. I'm Ron Milligan with REMAX Select here in Portland's Pearl District, and I've got a couple of predictions for us, but first let's talk about what actually happened. So back in the beginning of the year, December, the end of last year, we were experiencing interest rates in the low threes, the high twos in some cases, very much in line with what we'd been seeing the previous year plus. And then things kind of kept bumping along and the market was getting really, really hot. And then in March, the Federal Reserve Board, met and they did what they promised to do, which was raise interest rates a quarter of a point. And those are the Fed funds rates that they increased by a quarter of a point. It's not directly tied to mortgages, but doing so does have an effect on mortgages, and it had a big effect on the psyche of the lending world. That also happened, though, at the same time that they stopped buying mortgage-backed securities, which is a way to drive interest rates down, something that had been going on more on than off over the last 10 years to keep interest rates artificially low, and they stopped doing that as well. The market responded in a knee-jerk fashion, and interest rates started increasing at a really rapid pace. There was actually a week in there where interest rates increased by an entire point, like 100 basis points, an entire percentage point, in the course of a week. And we basically went from the threes to the fives and completely skipped the fours as interest rates rose. And we've kind of hit this cap somewhere around 5 to 5.5%, depending on the lender that you're dealing with and that you're following. What I do is I follow a couple of companies that do averages of rates that they see. But I have to keep in mind and let everyone know that different lenders are definitely going to have different rates. Right now, where the best rates seem to be found are with some of the big national savings banks. So like a Wells Fargo, a US Bank, a Key Bank, whatever it happens to be. Lenders that maybe we had been kind of avoiding because they weren't the best at loan processing processes, but right now they seem to have lower interest rates. In some cases, I'm seeing like a half a point lower than other lenders. And the reason for that is when the market reacted to the raise in interest rates, a lot of the lenders, knee-jerk reaction, freaked out, and built in the Fed's promise, kind of baked it into their interest rates. Because what the Fed had promised was, when they met in March, is that over the next 6 or 7 meetings that they were going to meet, they were going to continue raising interest rates, and they did that in April, just about a week and a half, a couple weeks ago, where they raised the interest rate, the Fed funds rate, another half a point, so another 50 basis points. The result of that, though, wasn't an increase in an equal amount of the interest rate. It wasn't an increase of another 50 basis points for mortgages. They kind of bumped up a little bit and they kind of held their ground a little bit until, now for the last couple of days, interest rates have actually been receding a little bit. Compared to a week ago in some of the companies that measure and average out interest rates kind of nationally, the numbers have decreased about 15 basis points from where they were a week ago. They didn't increase 50, and now they're actually kind of settling out a little bit. So I do have a couple of quotes from, this one is a little bit older. It's a couple of weeks old. It comes from Len Kiefer, the Deputy Chief Economist at Freddie Mac. And his quote was, "Mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate." And basically what he's saying is that crazy slingshot forward that we experienced in March and April, the beginning of April, probably we're not going to see that again. Rates may continue to kind of inch up. The other one that really caught my eye is one that comes from Bill McBride, who is an author of the Calculated Risk blog. It's a one that a lot of my clients follow and that I keep my eye on as well. And it's about all sorts of things with the economy, not necessarily about the rates, but I thought that this quote was good. Based on the current estimate for peak Fed funds rate, 3.25 to 4%, the 30-year fixed mortgage will likely peak between 5% and 5.7%. There is some variability in the relationship, so we might see rates as high as the low 6% range. This depends on inflation and the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6% is possible. Sounds like he's kind of hedging a little bit. Sounds like it supports that idea that the balance of the next 4 to 5 rate increases by the Fed may be already worked into a lot of these interest rates. We may continue to see interest rates move up slowly until we hit, this 5.7 at a max, or even as high as 6%. But that's probably where we're gonna cap out. So there's a couple of estimates that we've got, so a couple of predictions from some good analysts, and of course I'll keep my eye on this and share information with you as I have it. If you've got other sources of information or something else that you're following that you think I should, throw that down in the comments. I'd love to check it out. The more information, the better. And of course, always feel free to subscribe to this channel and like this video, and we'll see you with the next update.